Namaskar and good evening, friends. Today I am trying a new software called Zoom. It is very popular in some of the educational institutions, but of course I am not very satisfied with that. I'll be trying different softwares in future also. Today we will take a look at balance sheet analysis. As as investors, we must be able to analyze balance sheet, income statement, and cash flow statement. All these three to judge, to evaluate any company. So the first statement that we need to understand is balance sheet. Balance sheet is the first statement which starts with a company. Thereafter comes income statement and cash flow statement. These are the three statements. Quarterly, all the public limited companies registered on the NSE or BSE, they publish the quarterly statement. Many of them publish cash flow statement also, and some of them publish balance sheet also quarterly. But of course, annually it is mandatory. So let us try to understand the balance sheet. Very, very, very important for any successful investor. So let us try to understand the balance sheet. What's a balance sheet? The balance sheet shows you the assets and liabilities of a public limited company as on the date of closure of the accounts. In India, usually it is 31st March, but some companies adopt calendar year also, in which case it will be 31st December. But most companies close on 31st March. So the balance sheet is definitely published as on 31st March, and sometimes they also give the balance sheet as at the end of every quarter. That's well and good. Now we should know what is a balance sheet. The balance sheet contains assets and liabilities of a company as on the date of closure of the accounts. Now, what are the various types of assets? There are various types of assets: long-term fixed assets, long-term investments, and short-term assets or current assets. Three different types of assets are there. Long-term assets are like land, building, apparatus and plant, vehicles, furniture, and so on. They are all subject to depreciation every year. Depreciation methods are there, number of methods are there, and every year the value of the assets is decreased by the amount of depreciation. Then there are long-term investments. Different types of investments are there. You may invest in long-term assets of another company also. You may invest in fixed deposits, or you may invest in mortgages. So many. So long-term investments, long-term assets, that is fixed assets, and then current assets. Current assets mainly are accounts receivable or sundry debtors. So we sell on credit basis also to various people. It's a very important part of the business. So that's called accounts receivable. We know what is sold, how much it is sold, when it is sold, and before what date the payment is. Normally, every company gives their debtors maybe 45 days or 60 days or 90 days or 180 days sometimes, and so on. So the payments go on coming, and then accounts receivable or sundry debtor that goes on coming down. And in the meantime, fresh sales are there. So these are all credit sales. For credit sales, accounts receivable or sundry debtors arise, and then as and when the payments come, the accounts receivable comes down, and fresh accounts receivable gets added when fresh credit sales are made. For cash sales, there is no accounts receivable. Then inventory is there. So inventory may consist of raw material, works in progress, and finished stock also. So inventory is always there. Inventory is going away from inventory into manufacturing, works in progress, and from there they have become finished goods, and then from there they go into sales. And then short-term debts may be there, and then the current year portion of the long-term debts also is there. You may have to repay something during the current year out of the long-term debts. That also comes under current uh, assets. Somebody has to repay. What has to come is an asset. What has to be given is a liability. So as accounts payable, accounts receivable are there, inventory is there, cash is there, cash equivalent, fixed deposits are there, and whatever else is to come within 1 year, that comes under current assets. And then, so the total of long-term assets, fixed assets, long-term investments, and then current assets, the total is assets side total. On the other side, liabilities are there. The first and the biggest liability is to the promoters, to the shareholders, to the owners. So that's called shareholders equity. Shareholders equity, you and I all want to be shareholders of many companies. So we come there. So shareholders equity may consist of ordinary equity, preference equity also, and retained earnings. What are retained earnings? Every year, there will be profits. A part of the profits is disposed of as dividends to the shareholders. Balance remaining is called retained earnings. That belongs to the shareholders. So shareholders equity consists of ordinary equity plus preference equity plus retained earnings. Then there can be long-term payable amounts, long-term loans, liabilities, long-term liabilities. So you may take a bank loan, you may take a mortgage loan, you may take other long-term loans. So all these things come under long-term payable amounts. Then current liabilities. So just as we have current assets, we have got current liabilities also. Current liabilities are short-term debts, short-term loans, and then accounts payable. Just as you give credit sales to people, likewise somebody else is giving you credit purchases. You purchase on credit also many things. Raw material is usually purchased on credit basis. So all those things come under current liability. So three items will be there usually: shareholders equity, accounts payable, long-term accounts payable, and current liabilities. Long-term liabilities, current liabilities. The total liabilities is always equal to the total assets. Now, when you have a balance sheet like this with assets and liabilities, both of which are equal, how are you going to analyze that? That's what we now. So here what I have given is a balance sheet. Balance sheet you know now. Income statement is profit and loss account or quarterly statement, that is income statement. See, at the end of the year, in the income statement, we arrive at the net profit. And the net profit is the amount which is transferred to the balance sheet. So the connection between income statement and the balance sheet is that the net profit arrived at the income statement is transferred to the balance sheet. Likewise, cash flow statement is prepared showing cash inflows and outflows. We'll see all those things later on also, later in much greater detail. But for the present, understand that from the cash flow statement, the net cash flow at year end, goes to the balance sheet. From the income statement, net profit goes. The cash flow statement, cash at the year end goes to the balance sheet. Two items. I have told you assets is equal to liabilities plus shareholders equity. That is, liability side is equal to asset side. I have also told you there are fixed or long-term assets, long-term investments, and current assets. Then liabilities, shareholders equity is equal to equity and retained earnings. Then long-term liabilities, bank loan, mortgage, and other long-term loans. Current liabilities, short-term debt, accounts payable, current portion of long-term debt. You have to repay some debt. That comes under current liabilities. Now we'll go to the analysis side of the balance sheet. There are three types of analysis. One is called vertical analysis, another is called horizontal analysis, and yet another is called common size analysis. So what is vertical analysis? For each item on the liability side and on the asset side, what you do is to take the total, and for each line item, every item in the balance sheet, on the liability side, take the total and work out for each line item the exact percentages. Total will be 100%, total liabilities. But for each line item, shareholders equity may be 20%, long-term liabilities may be 50%, current liabilities may be another whatever is the balance. So these percentages are worked out for the liability side and also the asset side. On the asset side, for each asset, what is the percentage that you arrive at? So that's called, you put the numerical number, that is the amount in rupees, and plus the percentage in the total, that is called vertical analysis. The second type of analysis that we do is horizontal analysis. In the horizontal analysis, we take the figures of 2 periods, 3 periods, 4, 5 periods, up to that. And for each period, we work out the exact difference in numbers also, in numbers. So current period, what is the amount of the assets? Previous period, what is the amount of assets? What is the difference in rupees? That is called horizontal analysis. If you work out in ratios, it is called vertical analysis. If you work out in terms of rupees, it is called horizontal analysis. Then common size analysis. If you work out both in ratios and also in rupees, it is called common size analysis. In many of my analysis, I use all the three methods: vertical analysis, horizontal analysis, common size analysis. Common size analysis is being used in some of the websites also. Now, the last and another foremost important method of analysis is called balance sheet ratios. There are 4 types of balance sheet analysis ratios called efficiency ratios, liquidity ratios, solvency ratios, and profitability ratios. Now, what are the efficiency ratios? Efficiency ratios are inventory turnover ratio, asset turnover ratio, receivable turnover ratio, payable turnover ratio. 4 types of efficiency ratios are there. We compare the balance sheet items of inventory, assets, accounts receivable, and accounts payable with the turnover. Turnover means net sales. Net sales again means whenever you make sales, some of the items may be returned back to you as not good. So sales minus sales returns and also discounts. So that net sales is called turnover here. Inventory is compared with the turnover. Assets are compared with turnover. Accounts receivable are compared with the turnover. Accounts payable are compared with the turnover. Why? Inventory, assets, accounts receivable, payable. These are the four items. If you carefully look at the logic, these are the four items which ultimately become sales. Assets give us sales. Without assets, there are no sales. Likewise, without inventory, from inventory only the products go to sales. Likewise, from accounts receivable. Accounts receivable is what we have to receive, what the sales that we have made, how fast we are receiving the payments. That is accounts payable. Accounts payable, how fast we are paying for the raw material that we are getting. So these are the raw material that we are getting, raw material that we are sending out for manufacturing, and then the finished goods, and then the assets based on that is plant and machinery, etc. These are the four items which ultimately become sales. So the efficiency of a company, how much you are getting as sales, that depends upon this four items. So they are compared with sales. Inventory, assets, receivables, and payables are compared with turnover. The next type of ratios are called liquidity ratios, current ratio, quick ratio, cash ratio. See, you have accounts payable under current liabilities. Now, are you able to pay your current liabilities easily? If you don't pay current liabilities easily, you won't get your raw materials next time. Therefore, how fast we are able to pay these things, how easily we are able to pay the current liabilities, that is judged by current ratio, quick ratio, and cash ratio. Current ratio is nothing but current assets divided by current liabilities. Quick ratio, all the current liabilities, current assets we take minus inventory. The inventory we are not going to sell, we are going to make them into sales. Final, our products, we are going to make them our product. Therefore, in the quick ratio, inventory is omitted, other current assets are taken. The formula is current assets by current liabilities in both cases. But in quick ratio, inventory is omitted. In cash ratio, cash is the easiest way of paying. Therefore, cash divided by current liabilities. So these four ratios tell us how comfortable we are in making our payments, receiving our payments. The next is called solvency ratios. That is called, why it is called solvency ratios? We compare our debts, total debts. Now here it is not current liabilities. It is long-term liabilities. Debt to equity ratio, debt or interest service coverage ratio, debt to assets ratio. How much is the debt that we have taken? That is compared with the equity. Should not exceed a percentage of the equity. Now, having taken the debt, you have to pay the interest. So, are we able to pay the interest charges on the total debt? That what is your comfort in paying your interest? There are ratios for that. And then debt to asset ratio, debt to equity, debt to asset, and debt or interest service coverage ratio. These are called solvency ratios. You must be very, very comfortable in respect of debt to equity ratio, debt to asset ratio, etc. Many companies failed when they did not take care of their solvency ratios. Too much debt was taken, not able to pay the interest, and the debtors were pressurizing, therefore the companies failed. Then profitability ratios. All these are balance sheet ratios. There are other ratios for income statement, cash flow statement, etc. We are now talking only about the balance sheet ratios. The last type of balance sheet ratio that we are covering now are profitability ratios. Return on equity. Where from the profit comes? Now, how do you judge the efficiency of a company? which company is better for investment, which company is not so suitable for investment. You have to compare with the profitability, return on equity, return on assets, return on capital employed. Return on equity, how much the company is earning for the shareholders. So it may be 25%, 30%, or sometimes in some companies it is as low as 10%. So if they are earning their 30%, 40%, etc., they may pay good dividends. So that return on equity is very, very important. Likewise, return on assets. You have huge asset base, and those assets should produce net profit. Return here means net profit. So you need to compare your assets with the returns, that is with the net profits that you are making. So different companies have got different return on assets, different return on equity. So you will have to compare those things to find out which company is better for you to invest. Return on capital employed. Here, shareholders equity plus long-term debts. That's the capital employed for production of saleable goods and for selling and for getting net profits. So what is the return on the total capital employed? Because here you have to pay not only to the equity holders but also to the debt holders. You have to pay them their interest back, and also the debt also back sometime or other. So return on equity, return on assets, return on capital employed. These are the 4 different types of balance sheet ratios. Here we have seen what is balance sheet, what is balance sheet analysis, what comes from income statement and from the cash flow statement. Then what are the components of the balance sheet, asset side and liability side. Both sides should be equal. How to analyze. Now we have covered analysis of the liability side also. We have covered, tried to cover the analysis of the asset side also. These 4 ratios are seen. You have understood the balance. You have analyzed the balance. But suppose you have not analyzed all these things, you have not analyzed balance sheet. So we have covered balance sheet analysis from the investor standpoint. See, the formulae for these things also I will give you sometime later. But this much you need to understand. These ratios are important for understanding the balance sheet. I'll be covering the balance sheets of all the companies sometime or other. Normally we cover quarterly statements, but we cover the cash flow statement also, and sometimes I cover the balance sheet also. Now we need to understand all these things. If you want to be a real successful long-term investor on the NSE or the BSE, you need to understand balance sheet analysis, all these points. Thank you for listening. Thank you for understanding all these things. I wish you all the best of luck in future. Become an intelligent investor. If you know all these things, you will be an intelligent investor.